Good afternoon, ladies and gentlemen. Uh, I would suggest that we start from where we've stopped this morning. I think now we are ready to look at the preface of what we've done already. In cycle 2.2 CPD, we dealt with a few things in our disposal. That is the issues about shareholders and issues about the lenders. So in our previous scenario, we dealt with this in a number of ways. Yeah, in a number of ways, which I will want to recall quickly. One, when we looked at the shareholders, we looked at a few things which are the understanding of the financial statements for the shareholders to say, when we're looking at the financial statements as shareholders, what is it exactly that interests us? Or what is it exactly that we'll want to see? All right. So whatever it is, the shareholders makes an ultimate assumption that the financial statements themselves are accurate. These financial statements have been backed up by supporting documents. In other words, every cent that is in the financial statement is coming from a particular document, and the financial statements are prepared by a qualified person, and that qualified person together with a small business practitioner are getting guidance from the SPPSA, and the financial statements themselves are complete. We dealt with that when we were dealing with shareholders this morning. Okay, we also talked about the two types of shareholders. We talked about the shareholders who are called director shareholders, and we talked about external shareholders. When we talked about director shareholders, we talked about shareholders who are also owning the company, who are involved in the day-to-day running of the business. These director shareholders are interested in four things. They are interested in knowledge. They want to understand how to run a business. They are going to get a director's remuneration. They're going to get dividends, and they're going to get a business value. Then we also have external shareholders. External shareholders are the investors, are pure capital investors. They are only interested in two things, that is the business growth, that is the business value, and the dividends. We talked about those, and we made quite a good illustration yesterday about what exactly those directors are. All right, what are the shareholders looking for in the financial statements? We have dealt with this extensively in our previous session, and we talked about profitability in the income statement. We talked about business value in the statement of changes and equity. We talked about risk assessment when we're looking at going concern, and we looked at cash flow and the liabilities of the business. Now, in looking at the example that we are dealing with, we looked at the company performance, particularly in the income statement, and we realized that the revenue for the current year has increased, but the profits have decreased as compared to previous revenue, where the revenue was low, but the performance was better, which created a lot of controversy in terms of how exactly one should manage a business, and what critical indicating points which one should consider as the business is going forward. Because one of the difficult issues to deal with in that scenario was whether indeed the 2024 year financial year end was better than the 2023. It was really a big issue there. All right. Then we get to the business value assessment, where we're looking at particularly on what we call the shareholders' equity. to say what information from the financial statement can easily assist us to determine how much we must sell our business today. So it's the share capital, the amount in which you put in the business to buy the shares of the company, the retained earnings, all the profits and the losses that you have been incurring in the past. In other words, if your company has been doing comprehensive income, it means your retained earnings have been growing. But if in one of the years or continuously your business has been making a comprehensive loss, it means that your retained income has been decreasing. There might be other reserves, but normally these are not applicable to small businesses. Comprehensive income is the after-tax profit that the business is making this year. All right, so that is the sales or service rendered, less your cost of sales, less your expenses, less your interest expense, then you get to your profit. The forms of business, we notice that this business that we're dealing with is rendering services because there isn't inventory in the income statement and in the balance sheet. Maybe we are talking about inventory here because the business itself wants to create a separate division, or it's going to be acquired by a division that is selling inventory, or the business is diversifying now that there are also no cost of sales in the income statement. So those are the things that we looked at, and we looked at the asset analysis. We found that if the business can make so much money from the income statement, how come the assets are so small? We realized that that was confusing as well. In other words, what are the employees using to generate income? Because, for instance, if you are employing an admin person, you will employ an admin person with a computer. So where is that computer, or does that mean the business is using old computers? If the business is using old computers, at least we should see those one on the notes. All right. Which then raises a question to say, how come the business is making so much sales, but there is no corresponding entry on assets? Employee investments, we looked to say maybe there are new employees that are coming into the business, whether these permanent employees or whether these are temporary employees. What's going on to this business? Shall we see this scenario next year again repeating itself? In other words, the sales doubling or tripling or fourpling uh, with the manner in which they've done. Sorry, the manner in which they've done that. Also, what if the revenue is decreasing this year? What is going to happen, and so forth? Yeah. So we looked at the advantages of being a director shareholder. We've already mentioned that there are four things that one should consider when is thinking of being a director shareholder. And also we looked and say, even though this guy is a director shareholder, she does not have, in other words, the financial statements do not indicate any instances where the business is paying this person dividends. All right, so we looked at the cash flow and the dividend potential. We realized that between the previous year and the current year, the cash has increased on the cash flow statement. All right, although the cash is positive, we also noticed that there are indeed also liabilities, and we were confused about what this means. And because on the cash flow itself, we could not pick up any indication that the business has disposed of any of its liabilities. The liabilities are still there. Instead, they are growing. And what we also wanted to find out in our previous session was that, does the business do budgeting? And if so, what amount of the current balance, I mean cash balance, will be allocated into next year's budget, and why, and how is that determination going to be done. All right. It's worrying to know that the payment of statutory deductions has not happened. It's really creating some form of going concern, and the risk assessment is becoming bad. All right. The choice of payment prioritization to say if the statutory payments or deductions were not done, what else was paid and why, and what will the business do to back itself up when it comes to the statutory deduction. All right. If we take the current liabilities and of 769 and the current cash of 779, what should we do? Can we just pay all the liabilities and know that we don't have liabilities? And if that is an option, how is that option a benefiting option? Or how can we deal with our liabilities going forward? Should we just use half of the 769 to pay for the liabilities, or what exactly should happen? So those are the things that we're dealing with there. Calculating the business value, yes, it's the gist of what we're talking about, because we're talking about the shareholders. So let us understand what is the accounting equation, and is our accounting equation positive? In other words, do we still have which one is bigger between the assets and the liabilities there? If the assets are bigger, if the liabilities are bigger than the assets, it means there's no business value. The business value has all been eroded there. Even though in our accounting equation we have seen that there is a business value, we also talked that to say, look, taking into account additional qualitative factors, that amount can either increase or decrease. However, we also need to understand the parties who are valuing this business. The person who is selling the business may want to earn more in terms of value, and the buyer who wants to buy this business will try to come up with a very, very low figure on the business valuation. So what we will do, we'll take the midpoint being the summation of the seller's value and the buyer's value, dividing it by 2. So that will be the business value there. So investment comparison, we've already mentioned the types of shareholders: the director shareholder and the external shareholder. We mentioned that the director shareholder will get remuneration, will get dividends, will get business knowledge and experience, and will also be entitled to the business value. We mentioned that the external shareholder will be getting dividends and business value only. However, if you want to put your money on buying property, you will get the rental property and the dividend and the rentals. If you are putting fixed deposits to the bank, if you are buying fixed deposits from the bank, you will get your money together with the annual fixed deposit. We talked about the external auditors, and we said that the external auditors are appointed by the shareholders, and they take care of the overall users of financial statements. They don't, because they are employed by shareholders, only look at the advantages of the shareholders only. They also look at the advantages of all the users of financial statements. In other words, they consider all the fears of the users of financial statements. So let us talk about the independency. So they need to be independent. In other words, they cannot be the ones who have prepared the financial statements. They should be different. They should be they should be separate from those who have prepared the financial statements. So there must be a differentiation between those who have prepared the financial statements and those who are auditing the financial statements. let us remember that even though the shareholders would have appointed the directors, I mean the external auditors must be separate from the shareholders, they must be separate from the directors, and they must be separate from the accountants who would have prepared the financial statement. So there must be no issues about their independence there. Also, we mentioned that we're gonna deal with this chapter between chapter 3, 14, and 15. Okay. So you are urged to join small business practitioners there by clicking into our website, which will take you to the registration form. All right. Essential in this chapter, we looked at the financial performance for this chapter pertaining to the shareholders. We looked at the financial performance. We looked at the future outlook. We looked at the external auditors. We looked at the business value, and we looked at the cash flow position of the business and the role and impact of liabilities on the financial statements and how that affects the interest of the shareholders. In chapter 2, we looked at the how we should understand the lenders and what the lenders want to understand about the financial statements. We looked to say if a director is sitting here and wants funds to fund a certain product, uh, what choice does he have? Should he either go to the shareholders for money? And what if the shareholders don't have money? What if the issue is urgent and the shareholders doesn't have money? It looks like the ultimate is the lenders of financial statements. And when that person is going to the lenders of financial statements, the lenders of financial statements will start to do a financial analysis of this company. And they've got separate information that they are looking for when they are analyzing the financial statements of the company. Remember, the lenders are not borrowers of capital, are not providers of capital, but are the lenders of capital. I got a question after class this morning to say, is it possible that shareholders can also be lenders of capital? Yes, that is pretty much possible, especially when you are looking on preference shares, and sometimes when they are informal lending, you will find shareholders borrowing money to the company, but on an informal way there. Okay. Now, it's possible that when you want to fund a certain operation or a project, you may want to decide and say, I want to take a loan only. There must be factors for you to do that. If you want to take share capital only, there must be factors that you would have considered to do that. You may also want to consider a situation where you want to mix a loan and capital in equal proportion. In other words, you will say, I want to take 50% of the loan and I want to take 50% of share capital. Also, you might want to say, I'm still going to mix the capital. I'm going to take 20% of the loan and take 80% of the loan of the share capital. Or you may still say, no, I want to take 80% of the loan and take 20% of the capital. There are varying degrees of reasons on why one can do that. Okay, once you submit your application to the bank is going to put your application in what we call an application algorithm, and they start to analyze your information using a bank application there. All right. However, we have mentioned yesterday that that is not when your application starts. Your application for a loan starts when you start your business. They start together because you want to prepare your information so that you present a winning case. Okay. What are the things that would normally kill a a loan application? Okay, you will find that someone does not have a credit history, and you will find that there is excessive personal debt. You'll find that there are also erratic bank activity. We also talked and say people are encouraged to separate between personal expenses and bank expenses. So don't use a bank card for your personal expenditure. Okay, missing paper trail. We talked about that to say what type of information you must have to ensure that you are supporting or you are backing up your application. The types of loan, we talked about the types of loan, and we said one of them is a secured loan, and we said one of them is unsecured loan. We made an agreement with you yesterday that there is in fact no unsecured loan. All loans are secured one way or another. There is an instrument that the financier is using to secure a loan against you. We talked about safety houses, a surety and a guarantee, and guarantor, and we made specific conclusions there and specific remarks to say how you should gather yourself around those instances. We talked about other supporting documents that are not necessarily part of the financial statements, and we talked about the personal balance sheet, and we talked about the monthly budget, and we talked about the letter of drawings. A personal balance sheet is when a bank will want to find out what are your assets other than the assets that you have disclosed in the business. All right. They might also want to find out your spending. Where are you spending most? If they are giving you the loan, what are you likely to cut, or how will your salary to yourself will likely be opened up? Letter of drawings will happen when you don't have a fixed salary that you're taking from the business. In other words, where the bank has noticed that you are also using a bank card for your own personal, you are using a business bank card for your personal expenditure, and the bank would normally frown from that. Okay, then that almost concluded our cycle 2.2 CPD. So the next CPD that we'll be dealing with now is cycle 2.3 CPD. And in cycle 2.3 CPD, we will be dealing with chapter 3, that is the supplier of goods and services. And we'll be dealing with chapter 4, that is the company employees, which normally fall into one bracket, that is suppliers of the business. All right. Now, in looking at chapter 3, there are few comments that we would want to make. That chapter 3 deals with the supply of goods and services of the company. Now, this chapter, as we've already seen in the previous presentation, excludes employees as suppliers, since employees are taken as part of different suppliers into chapter 4, and that chapter will also not deal with chapter 3 aspects. So we thought we should take that out of the way. All right. So briefly, if we think of suppliers, we think of the following people. The people who are selling inventory to you, the transport of that inventory to your place or to your customer, you will need a supplier to do that. If you have waste material and there are people who are collecting wasted material from your shop, that is a supplier for you. Water and electricity, stationery that you use in the business, you might want a supplier for that. Cleaning material, Wi-Fi and data, alarm and camera system, security guards, those are all suppliers of your business. The people who are supplying you with assets, office equipment, computer equipment, office furniture, office improvements, and all of those. So those can be your suppliers as well. Blinds, if you've got windows, you might want to get those from someone else. Printing machines, ink, and so forth. All items around about printer, you might be having a supplier for those ones. The people who are giving you invoice accounting services, those will be your no, I think here what the author wanted to say was that when you do your invoice, it's either you are doing your invoice manually, then you might want somebody who's going to print invoice for you. But if you are doing your invoices on the system, that is also a supplier, because you need to buy that system or to rent that system. All right. The rental of the buildings, the rental of the photocopying machine, the accounting services, okay, the booking services, the bookkeeping services, the auditing fees, consultation and professional fees, repairs and maintenance, insurance, telephone, traffic fines, loss on sale of assets, impairment, depreciation, car and rental hire, garage expenses, traveling accommodation, fuel and gas, electrical expenses. Now, I want to separate these electrical expenses from water and electricity. Water and electricity, let me talk about electricity. It's when you go to the shop to buy electricity for you to light it, to switch on your plugs. You might not be buying that, perhaps somebody might be supplying that to you, perhaps the municipality. But when we're talking about electrical expenses, we're talking about a situation where you ask someone to come and change a bulb in your office. Then the changing of the bulb itself as a material is gonna go to repairs. But the cost of labor that goes with that one, I've seen that accountants get confused with this. It's either you take it as one thing to say these are repairs, you add up labor and the material. But if you want to monitor your costs and classify your costs properly, you can separate the labor for all the electricity items to say the labor that was costed for me on this electrical item was this much. So it helps you even to budget going forward. Yes, the other one can also help you to budget properly, but it takes a lot of analysis and a lot of time. We must mention to you that there are a lot of these expenses that we have mentioned, suppliers that we have mentioned above, and they will normally differ from business to business. But what is important is that suppliers and their products are carefully determined, especially at the beginning of the business, to say how we're going to classify, how we're identifying our accounts, how do we know which account must be affected at each time of the transaction. So those things are very, 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 very important there. It is also important that for the SPP and the FIB to do all what is possible to identify the suppliers and the accounts of the business. It is critically important that that is done so that we ensure that there is no mismatch in the accounting information there. All right. So perhaps let us just take care of a few things um, uh, uh, in this chapter. So here, if we're looking on the financial statement analysis for different stakeholders, we realize that the financial statements are crucial for the business success. Whether the financial statements are showing a loss or a profit, they still have information that is there. So this presentation is going to explore how shareholders, lenders, and suppliers each approach the financial statement analysis. Yes, we understand that they will do that using unique perspective and priorities. This means that before you can engage with them, these users of financial statements, you need to make sure that you've got sound financial information that you know pretty much that it has been performed very well with preliminary checks which ought to be done in the initial stage of the accounting period. You will need to have accurate and complete set of financial statements at all times. You will need to have financial statements that are produced by a qualified person, guided by a reputable institution like SPPSA, that are backed up by relevant and authentic supporting documents. So those are the qualities of the financial statements that we want to see at a small business environment. Okay, if we look at our agenda, uh, things that we have done so far, We have looked at the stakeholders in their broader perspective. If you remember, in when we started in the introduction, we looked at the stakeholders in their broader perspective, and we had a little chart about who these guys are and what they are looking to get. All right, we realize that these are different stakeholders and they are looking for different issues on the financial statements or from the financial information that you are giving them. All right, we looked at the shareholders and we did extensive look on the shareholders analysis. We separated between the two shareholders, that is the director shareholder and the external shareholder. We looked into what the external shareholder is looking to find and what the director shareholder wants from the financial statements. All that information we dealt with when we're looking at the shareholders when we started this afternoon. All right. Now, we also looked at the lenders and we said lenders would normally come as an alternative to shareholders and they've got separate accounting needs. Today, we're going to look at the supplier analysis and what we want to say is that suppliers are not completely different from the lenders, but they just lend a business for a short-term period, okay, and their approach is not as tense and rigid as that of the lenders of financial statements. So as lenders are reported on the non-current session of their financial statements, the suppliers are normally reported in the current section. So they all work with the assumption that the financial statements are accurate and complete. So there are no issues with those ones. But they will still do some form of accuracy checks to find out if really the financial statements are correct or rather accurate. You can see these three guys there. The other one is looking at the return on investment to say that one is a shareholder. The other one is saying this return on investment can be better if we can reduce the operating cost. The other one is saying what can we do to get more customers for us to grow our market share and to increase our revenue. Carefully to that, we must be careful of increasing revenue. What we have seen in the previous exercise is a company that increased its revenue to 11 million but decreased its profit. We saw a company that had a profit of 3 million but with huge profit. So that one must be done with great care, with great learning, with great learning and development, because increasing revenues without taking care of the costs might be a problem. That's what we see from those guys there. Shareholders focus on the profitability and return on investment. We now know that what influences their behavior. All right. We also know what is influencing the lender's behavior. Suppliers evaluate payments and operational stability, which are slightly different from the lenders. Okay, the suppliers would normally look for something that is different to what the lenders want from the financial statements, but there are glaring similarities between these two types of users of financial statements. All right. So the reason we are giving you these users of financial statements, we want you to understand these perspectives so that you are helped for your business to prepare appropriate financial information and build stronger relationships with each other, and so that these users of financial statements are able to understand one another, they are able to predict one another, and they are able to satisfy their needs. Okay. So as we continue with this, we're hopeful that this will help the directors to understand the amount of tasks at hand when it comes to creating and the development of financial statements. And we mentioned that the financial statement is not something that you meet up with at year end. It's something that you start with immediately when the year commences. Mind you, directors are not only responsible for the development of financial statements, but financial statements themselves encapsulate their utmost responsibility and is one of the most important aspects as financial statements are listed in the Companies Act. So you can see that one of the things the directors can do to overcome this task is to have good accounting systems, good guidance from SPPSA, a good foundation from getting through our material, a good team, the accountants that are learned, and accountants that are learning our techniques from here from SPPSA. People who have positive attitude and willing to learn, people who are able, who want to develop and do things correctly, and people who want to succeed using right ways and channels to succeed. So that is the way shareholders view this whole position, and their assumptions are based exactly on that. So when we look on the shareholder perspective, we find out about a lot of things. Uh, if you read the first statement that says, if your supplier went to lunch with your competitor, okay, so the issue there is that you are the customer. So if your supplier, because you are a customer, went to lunch with your competitor, what would they say about your payment basis, your professionalism, and your loyalty? In other words, when you see them walking together down the hill, will you be happy? Will you be relieved? Will you be more agitated? Will you worry? Will you perspire? Will you hate them? Okay. What if you see them laughing? Will you think that they are talking about you, or what, as they see you across the street? Okay. So these are the things that you should really think as you continue doing your business. Relationship focus. Suppliers value long-term relationships over one-time transactions to say, will this customer stay with me for longer, or is just a one-time transaction? The reason for that is that suppliers would want to do more for their customers if the relationship is getting better over time. Okay. And that gives a client an opportunity to demonstrate seriousness and reliability about what they want. Remember, in this bracket, you want to buy on credit for an extended period of time, or you are getting into a transaction that will allow you to pay after you have consumed the service. However, the service is not for free. The supplier is also worried if they are giving you the service, will they get something from you in return? Okay. Payment history. Your payment history patterns tell suppliers more about your business than formal documents. So here consistency builds credibility. So you might want to when you are making an application, you will give bank statements. Okay. So the suppliers will want bank statement combined with financial statements, and that information will reveal your payment history. Their access to credit bureaus makes them to understand your credit worthiness, and even for them to understand and see the information that you did not supply them. That is trust. So always be honest. Always have a logbook of information that details the engagement with your previous supplier, the good side about your previous supplier. Okay. So the credit application itself, when you are making it, is not always about glamorous financial statements, how big the profit you are making, how are your sales made of, but also a statement of growth and endeavor about what you have learned in each situation, and how has that situation helped you to grow, and how that has made you the most reliable customer than before. So the application may be accompanied by a statement stating out these instances where your financial statements are not good, where you are making these statements to back up why your financial statements are not good and why that position should not be reviewed as the end of the situation or as the end of life. In other words, how are you motivating and want them to see something better from what is reflected in the financial statement? So you can choose really to say, no, I want to cook my books. I'm gonna hire someone who's gonna give a good impression of my books, or you can say, no, I'm gonna send my books as they are, but I'm gonna have a motivation of why I found myself in this situation. What experiences did I get from this situation? What did I learn from this? And what controls in place and development areas that I'm putting in place to move out of this situation? So if you look on the last category there, we talk about communication, and we are saying communication must always be transparent communication about business plans. So we do not deal with business plan in this chapter. We deal with business plan in volume 19. We're gonna deal with that when it comes there, and challenges that have built confidence, which can help you to have partnership opportunities with your supplier. So communication itself is a very important tool there. But it is essential that this tool has originate from other senses as well. So you must be honest about your challenges. You must have a write up of how each challenges has risen, what caused that challenge, which part were you in the challenge, what were your strengths in that challenge, what were your weaknesses in that challenge, what caused the challenge, how did the challenge go away, how are you managing the challenge, are you ignoring the challenge, are you giving somebody else to deal with the challenge, what information are you getting to that challenge from that challenge, and what is the impact of that challenge to your business. So it's not all bad. You can see that it's not all bad, but it really depends on how you want to deal with it. All right. So one situation, people might deal with it differently. Someone may want to run away from it. Someone may want to give a positive outlook from it. Okay. Understanding the supplier category, we mentioned that they are above gross profit suppliers, and they are below gross profit suppliers. The below gross profit suppliers are the suppliers we talked about in the beginning of this session, but the above the above gross profit suppliers are suppliers of inventory. Okay, so at least now you've got an understanding of where each supplier and their line items will fall in the in the income statement. Income statement analysis is another topic that we're gonna deal with. Perhaps let us just make you remember that the income statement is where we analyze our performance, and when we're talking about profit in the income statement, we're talking about a situation where the sales were more than expenses. And when we're talking about losses, we're talking about a situation where expenses were more than the sales. If the sales are more than the expenses, it means your income statement is in a favorable position. If your losses were less than, if your expenses were more than the sales, it means that you were in a bad situation. You can get what you want if your losses are justifiable and fall within the current norms, depending on how convincing your remedial actions are going forward. It goes back to what we were talking about, ladies and gentlemen, that registering a loss in a particular year or two, it's not bad. But what the suppliers would want to know is, what are the steps you are taking to get out of that loss, and what remedial actions have you employed, and also what are the learning activities and learning lessons that are coming from that situation. So if we're analyzing our financial statements there, we're looking first on revenue trends. So suppliers will examine revenue stability and growth patterns to assess market position and sales capacity. So we can tell that positive trends are good, but it can be dangerous to show unjustifiable regression and too much growth patterns, as we have seen in our previous example, where the revenue jumped from 3 million to 11 million. Suppliers might have a problem with that. So we also see the profit margins. Consistent profitability indicates ability to sustain operations and meet payment obligation. Attention here is mostly on the sales generations and expense management. So even though your sales are growing, how much attention are you giving into reducing and managing your expenses? Do the suppliers see an opportunity to survive in your financial situation, or they just see a deathbed? So be careful of those things. So in what I've seen in some instances, suppliers, before they give you what you want, sometimes lenders have done this as well. They will call you to a presentation and they ask you to talk about your business and say a lot of things about your business. They will be asking questions from the financial statements from which you have to give appropriate responses. It's quite a tense situation. However, if you understand your financial information, if you have looked thoroughly in your financial information, if you've got a close relationship with your accountant, if you've been listening and attending to SPPSA guidelines, you've got no problem on how to answer those problems. So when you get the financial statement, don't be excited and pack them in a drawer. Go through your financial statements. Ask your accountant to explain what is in the financial statements. In fact, this is something that should be happening on a monthly basis. Remember, on a monthly basis, you've got a meeting with with your accountant and the FRC for them to explain what is happening or what has happened in the previous month and how we can use what has happened in the previous month to almost uh, prepare and avoid some of the things in the following month. Expense management, reasonable expense ratios suggest disciplined financial management and operational efficiency. What explanation can you give for expense comparison line by line? What is causing difference? Are the differences explainable? Are the difference normal, or are the differences unexpected, or they are just unsubstantiated? Be careful of that. What procedures do you have to monitor your business expenses? Do you just spend when you want, or you spend on demand? Do you understand the effects of unsafeguarded assets to the overall users of financial statements? Where are your assets? What is causing your expenses? Are your expenses caused by a loss of assets or are depleting financial resources? Be careful when it comes to that. Absorption capacity. Suppliers assess if the business can absorb additional cost of new inventory or services while maintaining profitability. So if they are giving you what you want from them on credit, what will that credit do to your profitability? What will that credit do to your balance sheet? What will credit do to your cash flow statement? Okay. So in the book, that is volume 7, we've given there a case study where someone wants to purchase inventory. So that was just an example. This person may want to purchase something else, but we thought that inventory can illustrate the point. It is not a straight win. Whatever the case is, the company managed to get inventory from that scenario, but after a lot of considerations, will the company manage to make money out of that inventory? Will that money be enough to make monthly payment for the acquisition of the inventory? Will the business always buy on credit, or will that credit help the business to generate cash flows that will help it to stay away from credit? Will inventory be kept safe from losses and damages? Will this ensure that will this transaction will the inventory bought from this transaction have enough storage facility? Are the storage facilities in a good position? Will the company be able to account for the inventory? What about inventory losses? What about the employees who are stealing inventory from the shops? What about rats and other insects that are destroying inventory? Will the inventory be accounted for properly in the books of account? Is the person who is the accountant of the business able to account for the inventory? Will management be cooperative in the accounting of inventory? Will there be additional steps that will be taken to ensure that the amount that was taken from the suppliers is brought back? In other words, the credit that you get from the suppliers, are there enough endeavors to ensure that that money is brought back? Now we look at the balance sheet of the business to say what are the suppliers looking at. There are three quadrants that the suppliers will look at. Perhaps before we can deal with the balance sheet, it is important that we just remind you what a balance sheet is. A balance sheet is a document that will be giving your state of assets, your state of liabilities, current and long term, and of course, will draw you to what your equity then is. So, suppliers will focus on the current liabilities and to see who else is in that category. So when they are looking on the current liabilities, they are comparing with their strength with the people who are sitting there, and they are asking themselves, why are these people there? Why they've been there? For how long were those suppliers have been there? Has the entity been able to utilize opportunities to reduce other creditors? For instance, in this case, the company had a cash flow of 797, had liabilities of 760,000. So the question there to say, has the entity been able to utilize opportunities to reduce the other suppliers becomes very important. What repeat circumstances could confine us for a long period? In other words, what could make us not to be paid by this person for a longest period? If we find other guys sitting there for a longest period on the creditors, what will really stop us from sitting there as well up until for as long as we can remember? So creditors are very interested to those instances. So what we have done here, ladies and gentlemen, we have included both current assets and current liabilities. There's a reason for us to do that, because we wanted you to understand that whenever there are current liabilities, the interest will always be what are the current assets as well. So on the current assets, suppliers evaluate liquidity through cash reserves and inventory levels to determine short payment capacity. Okay. When we're looking at the revenue, I mean receivables, if you've got receivables in your current assets, it means that you sold your inventory or you sold your services on credit, and the people who did not pay you are sitting in the balance sheet. So there are things that the if suppliers or lenders see the receivables in the cash in the current assets, they might generate some interest to say what supports these receivables. Okay, do these customers have contracts? Is there any debtors list? Is there any age analysis? Are there any invoices which, if they are added up together, can give this amount? Are there statements? Are there payments that have been made by these guys? If we pull up each statement for each creditor, of each receipt, of each receivable, can it give us that amount? Have you passed journals for impairment? How is your impairment impairment loss calculation being done? What is the impairment accounting that is being followed? In terms of accounting, do you have enough accounting procedures? Do you have a debtors master list? Can that master list still be segregated into debtors individual ledger accounts? Okay. Now, what the other question that they might ask in that current asset, if the inventory is not there or is there, why did the previous inventory could not buy itself? This is addressed by the questions that we have asked already. Okay, why this purchase will not have the same difficulties. Let's say you have already bought inventory in the previous past and you are still on credit and you are still buying on credit. They will ask themselves those questions to say why you are not getting out of this situation. All right. Then the current assets and liabilities will give you what we call working capital. The difference between current assets and liabilities show operational funding capacity and ability to take additional credit. But the relationship between current assets and current liabilities is very important one. Very important, especially when your financial information is based on accurate information and is backed by supporting documents. So, if your current asset is greater than current liabilities, it means your working capital is good. However, if your current liabilities are greater than your current assets, it means your working capital position is bad. Okay, so one will want to understand what is causing both of these situations. Okay, and as we go forward, you will realize that this requires a further analysis. Okay, so is the business currently operating on a positive cash balance or overdraft? Is one of the questions that can be asked there. Where is the cash coming from? Is it the cash coming from the director's loan? Which loan? Is the cash coming from the sale of assets? Which assets and why the business is selling assets? Or is the cash coming from the operations? Okay, is the cash all banked, or is some of the cash sitting inside the entity premises? The aim of all these questions is trying to understand the working capital ratio, the working capital stability, the strength of the working capital, the working capital quality. So these questions are not questions that are just asked out of the ordinary, but are questions that are asked to make sure that the supplier, when it's giving you money, they do that from informed reasons. All right. If we look on the cash flow statements, they say there the cash flow statement is the supplier's truth detector. Perhaps I want just to give you or remind you about the structure of the cash flow. The cash flow will have operating activities, they will have investing activities, they will have financing activities, they will have a balance from the previous year. They will tell us whether our cash this year have increased or decreased, and they will talk about petty cash and the balance at the end. So those items will summarily give us what a petty cash is. I mean, what a cash flow statement is all about. What suppliers will really look for? Consistent operating cash inflows. How much is actually cash than revenue? Is cash in the bank or in the books? Okay. Timely payment of statutory obligations. This could be a serious deal breaker to know that you are not paying statutory obligations, because they are asking themselves to say, if this guy is not paying statutory obligations, how much more us? How much more if he can do that? Can he really pay us? Reasonable cash balance maintenance. We have seen in our previous example where the business has moved from a negative bank balance to a very, very big balance there. So suppliers will be worried about this. What is the alignment between reported profit and actual cash generation? At least we have seen some alignment here, because we have seen that the profit was 450, the cash on hand was 750. So the difference between the two, it meant that the profit opened up a few items of non-cash items there. Cash flow is not an accounting, it's your survival rhythm. It's not about how much profit you made on paper. It's about whether you can buy bread tomorrow or not. Remember, the profit that is in the paper cannot give you bread. But if you take cash out of your pocket, you can buy bread. That's what the authors are trying to say there. So what are the red flags that we are seeing in the financial statements? Dramatic revenue increase, jump from 3.1 million to 11 million, which is 254% increase without a clear explanation, raises questions about sustainability and reporting accuracy. This is an issue that all the users of financial statements will have when they are analyzing these financial statements. So it's not an issue that will be picked up by the suppliers only, but all the users of financial statements will have issues with this part of the situation. Cash flow discrepancies, differences between reported cash balance of 774 and the and 34,000 rand in the balance sheet creates uncertainty about actual liquidity situation. So one will ask, what is the real situation? I just want to remind myself about that situation. I just want to remind myself about that situation to say what was the issue there. I just want to remind myself about the situation to say what was the issue on the financial statements. Uh, okay, these are the notes. Here is the balance sheet. Oh, here on the balance sheet, the cash and cash, the cash and cash, the cash and cash is 34,000 here, and on the cash flow, the cash and cash 774. Yes, they are right. Okay, differences between the difference between the reported cash balance of 774 and the balance sheet figure of 34,000 create uncertainty about the actual liquidity problems. It means there are a lot of items that were not reported to the accountant here, caused by the raise in previous in revenues, but which were not tallied up with the supporting document. This, in fact, makes all hope to see 2026 financial year information. This makes us all hope to see the 2026 financial information. A question has to be asked. What is this? What is this scenario drawing to the management's mind? Is the management listening to these questions? Are they making up enough steps to address these issues going forward? Will they implement some controls to address some of the issues going forward? Do they have cash management controls? Do they have expense management controls? Do they have record management controls? Have these concerns been taken into account in dealing with the current operations? And if so, what changes are going to be made in the next year? Outstanding statutory obligations, that is significant UIF, VAT of 554,000, liabilities suggest potential cash flow management issues, or attitude towards compliance, or the business generally have got compliance problems. However, at the UIF stage, we should also look to say whether the company does not close its return directly with the Department of Labor, and if it does, it means the liabilities are overstated. They must be reduced by the amount of proof of payments of UIF that have been paid directly to the Department of Labor. These are the issues that must be followed up in the next accounting period, and there must be clarity on how the business pays its account. There is also no indication about COID, but we are not worried about COID because we still have to settle some of the amounts during May this year. All right. Will the entity close its COID account with the Department of Labor on time? Will that correspond with the entity closing the EMP 201, EMP 501 returns? we did not see any information in the business about the EMP 501. What is happening about the employees tax? The company, is there no employee in the company that qualifies for the employees tax? All right. Is the company up to date with the employee related taxes? There are no liabilities related to it on the financial statements. Also, no related payments relate to it on the cash flow statements to say these payments related to the pay as you earn. If we look on the working capital deficit, the deficit is caused by the fact that current liabilities exceeds current assets before adjustments, indicating potential liquidity challenges. The next step will be to look at the solvency test. This is an alarming and needs a major attention. Maybe it may be necessary to explain, to get some explanation from the management. What is exactly the working capital of the business? Why the working capital is like this? Why is the working capital so important in the management? Why is the working capital important to the business itself? Why is the working capital important on the analysis that is made by the users of financial statements? What are the working capital ratios? What are the working capital ratios based on true account records? Why are these ratios important to the overall users of financial statement? What information must be obtained from these ratios? What are these ratios telling us? Are there any preventative or remedial actions that must be done from the information that is coming from these ratios? What is the difference between a working capital surplus and a working capital deficit? Those are the issues that are coming up in this slide. Really, you can see that the analyzers of financial statements really, really want uh, really want things to work in this particular situation. All right, and the questions that are being asked here are asked mainly because the aim is to help the directors to do what is right going forward than to leave them without a knowledge. Okay, I'm sure you are also learning from your side to say what are the things that I really need to take into account. How do I need to position myself when I'm dealing with information relating to the suppliers? Going concern assessment, it was part of the risk assessment. The supplier is the suppliers will, especially when looking at these financial statements, look to see what should we consider and what we should not consider. There are warning signs. Okay. Also, the going concern is important when it has been continuing the same way. In other words, the warning signs have not been improved. Okay, what are these supplier warnings? Erratic order patterns indicates cash flow problems. Okay, is this the first time order or is different from the previous order? Consistent late payments indicates default. How the payments have been in the past. All right, can we pick up the payments from the bank statement? Can we pick up the payments from the credit bureau? Can we pick up the statements from the financial statements? Avoiding communication, hiding problems, taking the calls when you have to, and give prompt responses to emails all the time when the supplier is writing to you. Reducing the order quantities, you are now buying less, and it could mean that you are selling less as well. Okay, or are you buying less because you are not selling? You've got piling inventory on the stores. If you are having piling inventory on the stores, what is really causing that? Okay, suppliers would want to know that. And if you have got piling inventory on the stores, why are you buying? Why are you continuing buying inventory to them? Is the inventory that you are buying the same inventory that is on the stores? Or is it different? If it's the same, why? If it's different, why? Are you having different markets? What is your economic position? What is your economic market position? And you can see that These are not ridiculous questions suddenly stopping orders. The suppliers are wondering, where is our customers? This might not be the issue since an order is now being placed, but the fact that you are placing an order now could really relieve them there. Suppliers assess going concern through behavior patterns more than formal declaration. We should also assume that maybe the entity will be selling inventory for the first time since there's no history of inventory. But we should also make you remember that we have made inventory here as an example as well. Okay. But needless to say, these are the questions that the suppliers might be asking. Let us assume that the business will be selling inventory for the first time. Since it will be selling inventory for the first time, dealing with inventory supplies, the following notes must be taken into account. And the supplier would want also to know what are the inventory controls that are available in the business. Because if you supply inventory to someone who will not be able to convert that inventory into cash, you are hitting yourself. Okay. So, as you get into this supplier relationship, make sure that you build confidence by doing the following. You communicate regularly about your business cycle, you share positive developments with your suppliers and small wins, make consistent and even partial payments towards the creditors that you have. Maintain visibility, don't hide away, diversify customer base to reduce dependency. Maybe it addresses that question that we have asked before, which was asking why are you buying different inventory items? It could mean that you have identified different customer bases. Maintain emergency reserve, which is very difficult also to do. I want to talk about the part that is saying make consistent even partial payments. That is very difficult because the attitude is that you always want to buy, you always want to pay the full installment there. All right. So don't beat yourself if you can't make a full payment. Pay what you have. Okay. Start diversifying. Start early because it takes time to diversify. When we look on the emergency cash reserves. I must tell you, maintaining cash reserves is not easy when the business is starting. Okay, but these may help you as you start small. Okay, and if you combine all these factors, we can say that these are the advice indicators that must be applied to all other suppliers to ensure that there is a positive relationship between the business and them. Okay, always make it a point that you don't hide. You are able to take their calls, and where you cannot take their calls, tell them at what time they should call you and respond to their emails. Responding to the emails does not always mean that you've got an answer, but you can always say, "Dear Mr. Fusane, thank you so much for your email. I have received and I will give a feedback shortly." The suppliers are very happy about that one. There are a number of other things that you can do to deal with your suppliers. We've already mentioned that one of the things that you can do is to foster open communication that will give you mutual benefits. The other thing that you're gonna do, you can align long-term goals for shared success. The other thing that you can do is to ensure that there is fair, timely payments that builds trust. What also you can do is to ensure that you establish clear metrics for performance evaluation. One of the things that you can do is to collaborate on innovative problem solving techniques. What you can also do is to create joint risk management plans with your suppliers. And lastly, you can appreciate and provide constructive feedback to suppliers. Most people don't want to do that, but I found that those are some of the things that can really help you to build a positive relationship with your supplier. So those are the things that one would want to consider when he's doing business with the suppliers. Building a payment reference portfolio, we talked about this previously, and we said one of the things that you can do is to have a payment calendar where you indicate which payment you have done for which supplier and which particular date in which month, in which date of the month. You document every payment. So what I've seen some of the business doing, we have seen them keeping screenshots of the payment, have filing receipts on the file, and getting payment, saving payment confirmations outside the banking apps, and organize their suppliers by payment date to say on this date I'm paying this supplier, on this date I'm paying this supplier, on this date I'm paying this supplier. So there's a grouping of suppliers. So some of them will also go on to have documents that detailed payments. Okay, so what they will do, they will support every payment by age analysis. This you should do to ensure that you have a complete supplier list so that it's always easier for you to reference to payment details. Request for payment testimonials. Uh, Ask loyal suppliers for a brief written statements about your payment reliability, because you want this to help you when you want to get into another supplier. Preferably, this must be sent to you via an email and must always be on the letterhead of the supplier who's giving you a testimonial. Maintain digital database references. Build a network of suppliers willing to vouch for your payment history when approaching new vendors. This can be done, but may take time to finally do it. It's always better if you do it from the beginning. Demonstrate payment consistency, show patterns of reliable payment behavior over time, even if payments are small. What is important is to record that you have met your commitments when they fall due. On instances where you could not pay, send an email, explain why you cannot uh, pay, and make a commitment. At the end, show where you have made a prompt communication to suppliers on instances where you could not pay, and the proof of payment later on confirming the commitment that you have made. You can see that running a business is not those who are weak. You really have to be strong, and you must understand what must be done, when it must be done, for what reason it is being done. So you can say that what we have given you now is that we're giving you good experiences of what we have seen, what has worked for other people, what differentiates between the people who work with us and those who don't work with us. The amount of skill that we're giving you, the amount of the administration perfection that we want to build in your mental base, the advantage that we're giving you for working with us, the experience that we're sharing with you to win. You can see that these things really are not coming cheap. Approaching the suppliers, which is what is the best practice. Okay, there are four things that you can do. You can prepare a business plan, focus on relationship, start smart but consistently, show your business plans. Okay, so we are not dealing with the business profile here and business plans in this chapter, but it is important for you to remember that these are dealt with in volume 19 together with business plan. A business profile is when you create a simple one-page summary of your business, even if it is handwritten, showing them how serious and organized you are. Perhaps we might want to talk a little bit about what is a business plan, a business profile. A business profile serves as a professional introduction to a company, outlining its mission, values, offerings, while attracting potential clients, investors, and business partners. There are five key things that we would want to mention to you about these about a business profile. First, it's an overview, informative overview. A business profile provides essential information about the business, about the company itself, including its history, its objectives, and operational details. A business profile helps stakeholders to understand what the business does, and its core values. So that falls under number one, that is informative overview. Let us go to attracting clients and investors. By highlighting the company's strength, achievements, and unique selling points, a business plan can effectively attract potential clients and investors for you. It serves as a marketing tool that showcases why others should engage with your business. I want you to be careful here that there is nothing at this stage that talks about weaknesses and threats and opportunities. It only talks about company strength, achievement, and unique selling points, and nothing else. And that's where we want you to limit it when you're doing your business profile. But we're going to deal with this when we're dealing with volume 19. Business brand and image is the third key purpose. A well-crafted business profile contributes to the establishment of a strong brand identity. It communicates the company's vision and mission in addition to what has been said in the informative overview. It helps to differentiate it from customers and fostering a positive perception about target audience. So it's a careful crafted document. Let us go to number four, guiding internal communication. The business profile can serve as a reference for employees, ensuring that everyone communicates a consistent message about the company's goals and values. This internal alignment is crucial for maintaining a cohesive brand image. This is the document that must be at the heart of the employee's mind. The whole company must talk one language about where the company is, where the company is going, what the company stands for, and where the company is going. Let us go to number five, support business development. A business profile can be used in various contexts, such as grant application, social media profiles, and professional directories. It provides a concise summary that can be easily shared and adapted for different purposes. Now, if we want to conclude on the business profile, we can say that a business profile is a vital document that not only informs but also persuades and engages various stakeholders such as lenders, investors, and suppliers. It encapsulates the essence of the business through its clients, making it an essential tool for business communication and development. At the center of the business profile are its customers, followed by the rest of its stakeholders. By effectively crafting as a business profile, companies can enhance their visibility and credibility in the marketplace. So you can see how much work must be done when we're creating a business profile, and you can see what benefits are there for lenders and the suppliers. You can see that the business profile does not only look at the interest of the lenders and suppliers, it looks at the interest of all stakeholders of the business by sending important message points about the business. Focus on relationships, approach suppliers as a potential partners rather than just transactional sources. All right. So we talked about start business, start small but consistently, establish a pattern of regular, reliable purchases before requesting credit terms. Okay, have a way to start your supplier relationships. We have already given you a number of indicators on how you can do this. You know your strength, you know your weaknesses, you know where your business is at a particular moment, you know the strengths of your business, strength of your business, you know your weaknesses, so you can really develop this particular practice yourself. Share your plans, communicate your business goals and how their product fit into the strategy of the supplier. Find a way to persuade the suppliers what great relationship it will be when they partner with you. All right. Suppliers want customers that are reliable, not ones of haters. Okay. Approaching suppliers is not about buying, it's about becoming visible. It's not about the transaction, it's about the relationship. We have talked about a number of things when we talked about the relationship. We talked about this, but it may be necessary at this point to go further to emphasize our point. Okay, so it is always important that you keep the details of the supplier, of all your suppliers in place and in an easy reach at all times. Suppliers must always say that you are serious about them for them to take you serious as well. All right. So these are the things that you should consider when you are dealing with your suppliers, and these are the things that you should consider if you want to win with your suppliers. Okay, because here you want to foster positive relationships. Okay, you don't want just any relationship, but you want a relationship that is gonna survive with your suppliers. So for them to analyze your financial information, they must have this information going forward. As you proceed with them, they must understand what type of a buyer you are, or what type of a buyer you have been to other suppliers. Okay, if we look on the cash flow management for supplier trust, we've got four quadrants there. We've got track weekly cash, where you have to monitor all the cash inflows from the sales. All right, monitor all the cash from the sales, deposits, and loans, and establish predictable patterns there. Okay. Okay, so what you can do there is to, when 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 people are, when you're making deposits to your bank statements, clearly set out that that deposit is a cash, that deposit is a loan, that deposit is an equity, so that there is really no confusion about what each of them is. Okay, use the MSRS to clearly set out what your revenue you have made at each particular point, or what is the purpose of each credit transaction in your financial information. All right. Build reserve, create emergency fund, cash buffers to handle seasonal fluctuations and unexpected expenses. We've already talked about this and how difficult this is. Difficult as it is to build reserve, but it's something that can be done if it started small and it started early. The biggest challenge here is to start. Whether you start big or small, have a way of starting this reserve. If you start big, it must be not you must not be creating a fund where you always run to, even if you've got small obstacles in your business. Document management. This is where you record all your outflows of stock, utilities, salaries, and other operational costs. Perhaps we may want to you may want to have the following documents when you deal with suppliers. You may want to create a file that will be for all the suppliers, so you have one file or more files that have different suppliers. You divide the file into supplier names and account identification, to say Max and Max printer. So that Max and Max is giving us printer, that is the account identification. Mention what the supplier supplies. They are supplying us with the printer and the printing supplies. Or some printing supplies are things like paper and ink, or they are just supplying us with printer only. The reason you are doing this, remember, at SPPSA, we're trying to create an environment where your entity can be run by somebody else at your absence. All right. So that when that happens, the person must find this situation very, very much easier and doable. Match the suppliers to the GL code and account mapping. So the supplier that is in the file, we must see it in the mapping, and we must see it in the GL code, so that the trial balance is okay. include the supplier details, and do not delete but insert new ones. What we have seen is that people, when they get new suppliers, they delete the old ones. No, just underneath that, write a new supplier, which is also matched to the above mentioned documents. Include tags to separate between main or alternative suppliers. Remember, when you have suppliers, you may have a supplier for instance, let's take the guy who's doing our electricity at the office. We'll find that we've got 4 people who are doing electricity in the office. So if we've got an emergency, the plugs fall off or whatever the case may be, or some of the things trip the heater or the kettle or whatever it is. So we'll call one of these guys, but if that person is not there, we call the second one. So we will rank them to say, in any case, this is how we call them. We always call them in this order whenever one, but they all fall within one supplier category. Always have the following: the payment calendar, the payment confirmation bank letter, invoices, debit notes, receipts, emails about payments, emails about proof of payments, the proof of payments themselves, payment reference letters, testimonials, and letters of appreciation. A section that deals with open and closed communication, especially when there are items that dissatisfy you or complaints about the supplier. So it will help you to understand how you have dealt with its situation, what caused its situation, how its situation was closed. The supplier reconciliation, the supplier age analysis, your accrual schedule, the MSAS, the supplier contracts and amendments, the contract amendment and date schedule, the payment requisition, the account records must be in place, your journals, your GL, your TP, your management accounts, your financial statements, your projections, your business plan, volume 19, your business profile, volume 19. Qualifications of your accountant. Your file must always be reviewed regularly to ensure that it is always ready and it is up to date. Where it is not up to date, those what makes it incomplete must be identified. So those are the things that you done. Ladies and gentlemen, running a business is not a joke. So we're trying to show you the level of engagement and the level of management responsibility that is there when you are asked to run a business. Consistent cash flow management demonstrates business discipline that suppliers value more than occasional payments. Be careful to that. Calculate your difference regularly, determining if your cash flow is positive or negative to identify trends and issues, and you solve those on time. All right. So it's very, very, very important that you do that for us. Okay. Now, what do we see when we look into each of these stakeholders that we have dealt with so far? So if we look on the financial element, profitability, shareholders are interested on the return on investment. Lenders are interested on the debt service capacity, while suppliers are interested on operational sustainability. If we look on cash flow, we can say that amongst other things, shareholders are interested to dividend potential, whilst the lenders of finances are interested to repayment ability, whilst the supplier focus on payment reliability. The asset as an element, the shareholders are interested to say how much growth is this asset bringing into the company. The lenders are interested to find out if they can use that asset to hedge against their loan. The suppliers want to know how much that asset produces in terms of inventory. Liabilities, the shareholders are scared to say what type of liabilities can influence their control. Lenders want to see if they still have space to give me more money on credit, and suppliers are worried if you are able to meet your obligations with this amount of liabilities. Time horizon, your suppliers, your shareholders would want to stay with you for a longer period. Lenders are also borrowing you long-term capital. That's why it is included in the non-current liability section. and suppliers are just there to keep you going with time. Understanding these priorities helps businesses prepare appropriate financial information and build stronger relationship with each stakeholder group. I just want to talk about now the debt ratio. All right. The debt to equity ratio has been dealt with at length in these preparations, but it is now time for us to talk about the debt ratio. What is a debt ratio? A debt ratio is a financial metric that measures the company's assets that are financed by debt. It talks to the level of assets ownership in the balance sheet. It asks how many assets are still there for them to be taken collateral against. All right. Now, what have we learned on the suppliers? One, it was a very interesting session. Two, it got me talking about a lot of things. All right. But more and importantly, we saw us coming into four quadrants, the financial statements that are telling different stories. Cash flow is our credible currency. Supplier relationship must be built on behavior and documentations that create leverage. Okay. On the first quadrant, we found that the users of financial statements read financial statements through their unique lens or interest and risk. So we need to prepare our financial information accurately and completely. Then on the second quadrant, we realize that we want our financial statements to be predictable. Well-managed cash flows demonstrate business discipline that suppliers value more than occasional large payments. Okay, so consistent payment, it's more important than to put bulk payments unexpectedly. Supplier relationships are built on behavior, payments pattern, communication style, consistency matter more than formal documents when building supplier trust. But we are not saying there must be no documents there. On documents management, that helps to build a portfolio of payments references and financial records that create negotiating power with new suppliers. In the first quadrant, we pick up that the users of financial statements are the same, but they look at similar information. Hence, we say these are generic financial statements. Financial statements must be prepared accordingly and properly. So we need to use qualified people who are guided by SPPSA bookkeeping principles. Okay, so on the third quadrant, we've dealt extensively with how you should foster client supplier focused relationships. Okay, in this presentation on the last quadrant, we've included a detail of records and a list of documents that you should always have in your disposal and which you must always ensure that they are kept up to date. So this also talks to the money that you are going to pay to your accountants. The amount of work your accountants do and the amount of relationship you have with your accountants as opposed to accountants that are outside SPPSA can almost tell you whether you are in a winning or you are in a failing relationship. It's up to you to decide. Let us now go to the employees of the business as the second chapter to this presentation. Financial statements are the foundation of business decision making. They reveal the true health of the organization and provide critical insight for all stakeholders, from shareholders and lenders to employees and government agencies. So the manner in which financial statements are prepared, the knowledge about the roles and responsibility around them is crucial. The relationship between the preparers is essential to understand the importance of the products to be produced at the end. The financial statement process must be started early and in the beginning of the year, and that process must be started with an end in mind. After the draft has been made by the accountant must make means to present the financial information to the users of financial statements, answer all questions, and the figures as point out the documents that are backing the financial statements. All right. So it's not just a matter of taking as an Excel and do the financial statements. There must be a schedule that is backing up each financial statements there. As a recap, who is using the financial statement so far? So we've looked at the shareholders, and we now know that there are different types of shareholders, but at the gist of it, they are looking at the investment and the business growth. We also have the lenders. We looked at the lenders. We saw that the lenders are keen to give money if credit worthiness and risk assessment is good. We also looked at the suppliers, and we realized that they only want to ascertain if payment reliability is good. Now we're going to look at the employees. Their task is to gauge job security and company stability. Perhaps we must mention that each of these stakeholders has a unique need, responsibility, and concerns when reviewing the financial statements, but they depend on one set of financial statements. I am sure you can see how powerful a well-prepared set of financials can do to the market, to the business itself, and all other stakeholders. I think so far you might have picked up that some of the users of financial statements can wear caps of other financial statements to validate their points. So be careful when you are doing your financial statements. When you are sending your financial statements to the bank, don't only focus. I'm talking now about those who cook the financial statements. The problem you will make is that you will want to focus in impressing the bank, but the bank can take a step back and say, let me wear the cap of a shareholder in this financial statement. Let me wear a cap of a regulator in this financial statement. And you find that because your financial statements have been cooked with a particular intention in mind, you still fail. Okay, so be careful. We don't want you to get into that situation. Employee, your most valuable assets. Employees represent the largest component of the business sector in South Africa. The South African economy is largely labor intensive, making employment heavily regulated with numerous laws protecting workers' rights. Okay, the entity is an example of that situation, looking at the amount of salary expenses that have been paid in the year 2024. All right. For instance, if you look on the director's remuneration, it was 2.4 million. If you look on the salaries, it was 6,524,856 rand. If you look on UIF, it was 65,248.56 cents. If you look on COID, it was 13,049.71 cents. However, if you take that money and you sum it all, it becomes 9 million 3,154 rand. And if you take those expense as a ratio of the total expenses, your ratio becomes 94%. And it tells you that this company is employee intensive. We should remember that with all the laws, they are applied the same way across businesses. As a result, we should point it out to you that when it comes to employees or any other law in South Africa, there is no small or smaller, big or greater business. Compliance is treated the same and is eventually through the court of law. While unions serve as a formal structure to represent employee interest and bridge communication with employers, most small businesses do not have unions representing them. This space hasn't been sufficiently mobilized for unions affiliations in South Africa, but a question has to be asked if it will help to have unions in a small business environment, or if it will not damage the small business environment at all. If it will come up with added advantages, what are those added advantages, and what education should be there to to take advantage of those unions. Financial transparency with unions, there are three quadrants that we have there. We have the current reality, we've got future direction, and we've got key assumptions. If we look on the first quadrant, most business owner managed private companies don't give financial information to their employees. Financial information is always kept away. This creates distance between workers and the financial health of the organization. I'm not sure if that is something that can be solved, or if it can really create advantage for both the employer and the employee, or if it can create some problems. But what we have seen in some instances is that showing employees how much you make, or how much the business earns from its customers, can really help the employees work much harder, and they can use that as a motivation even to get better salaries. If we look on the future direction of this quadrant, the second quadrant, future direction, a small business become more professionalized, hiding financial information may become obsolete in the future. Transparency builds trust and engagement, but I think there is also a lot of education that must be done between the employer and the employee. One of the problems here is trust. One of the problems here is that most employees in the small business environment, they don't stay long, and they don't intend staying long in one business. I have seen instances though where employees will stay longer with one employer. Key assumptions: for a meaning analysis, we must assume that employees have access to the financial statements to understand the business through their expectations, through their perspectives. Otherwise, this chapter will make no sense if we can talk about employees as users of financial statements, and when we know that they've got no access to the financial statements. Financial statements transparency isn't just about compliance, it's about building a culture of trust and shared responsibility. I think that is, in a nutshell, a summary of those three quadrants there. We must remember that employees are internal suppliers, they are not external suppliers. Employees function as suppliers to the business, and they are not expected to issue an invoice to their suppliers. They render services while stationed within the organization under the employer's control. This is why they appear as cash paid to suppliers on the cash flow statement, and this is why they cannot issue an invoice. The difference is that, unlike external suppliers, employees cannot easily refuse to offer services to the due to payment concerns. Once hired, labor creates material obstacles that restrict them from behaving like ordinary suppliers. So even if you are not paid in the previous month, you are still expected to be at work in the following month up until the situation is really unbearable. So the salary that you get in one month, it must carry you fully in the second month. If you are not paid, then you might not come to work in the third month because your salary is gone. All right. These laws are dealt with in volume 11. However, to assist you with the ultimate compliance with the employee administration and taking care of these laws, so that you know the direction you take, and to ensure that you are taking a right direction when dealing with your suppliers, you must have the following documents. There are instances where your employees are gonna resign. So you must have what we call a UL-19 Department of Labor form, which you will use when your employees resign. Your employees must have a contract of employment. There must be charts, Department of Labor charts in the walls of your institution or in the phones of the employers. Your company must have a CF registration. You must have a schedule that details all the employees and all their important information. You must have a UIF guide that tells you how much each employee must pay, how much you must pay towards that contribution. You must have an SDL guide that is going to guide you when you qualify to pay SDL and how you must pay SDL. You must have a COID guide that tells you how much you must calculate your COID. You must calculate the pay as you earn for each employer, or if there is no payment that must be done, there must be at least a calculation that shows that there is no employee's tax that must be done. You must have a schedule where you are calculating your UIF for your employees. You must have a schedule where you are calculating your STL for your employees. You must have a schedule where you are calculating your COID. You must have a leave policy to say when is the leave taken in your organization. You must have a schedule of how each leave is calculated and how it affects employee salaries. You must have a schedule of leave balances. You must have a disciplinary schedule. You must have proof of pay slips. You must have proof of payments that have been made to the employees. Those proof of payments must be traced to the bank statement. You must have what we call the monthly payment procedure to say how do you sum up your payment procedures at each month end. You must have a payroll ledger. That information must be traced to the cash book. That information must be traced to the transactional log. That information about management, about payroll management must be reported in the monthly management report. We must have an FRC report. We must have a bookkeeper's report. I'm not sure why that is different from an SRC report. We must have a tax report to say how have we dealt with taxes coming from the employees. We must have a report about the operations, the payroll operations from the chartered accountant. We must have a finance report that is going to be directed to the owner of the business. We must have a list of transactions. We must have job descriptions and employment contracts for each employee. We must have a list of prepaid expenses where the employees have asked for advances. If employees are entitled to other benefits like driving a company car or using company assets at home, we must have a schedule for that. We must always print or make available the EMP 201 statement and EMP 501. We must have important payment dates for employees, and we must have proof that we've paid the EMP 201 each time it was due. Now there is also what we call now the what the employees will look for on the financial statements. All right. So when they've got access to the financial statements, the employees themselves might want to look at some of the things that will benefit them. There are four things that they will look at. They will look at the going concern. They will look at the company size. They will look at the profitability. They will look at cash flows. Let us take it out of the way and remember that when we're talking about employees, the we're not only talking about the current employees the entity has. We're also talking about prospective, incoming, and future employees that are looking at the financial statements of your business. One of them is the going concern. So the information that they are interested in there is that is the company stable enough to provide long-term employment, that is inside or outside employees. Company size, does the organization match the employees' career aspirations and provide appropriate opportunities? Profitability, can the company sustain its operations and meet payroll obligations? Cash flow, will the salaries that is paid be consistent and be paid on time, and whether there are any growth opportunities within the company. However, we have picked up that even if these are not in the financial statement, desperation and economic situations against the employer can cause the employer taking up the employment with you, and that is very dangerous as some of the employees will soon leave. Dangerous in the sense that the recruitment cost of employees are very high, and recruiting every time may also harm your business. What can we talk about the going concern of the business as a continuation from the previous slides? What we picked up from small businesses is that employees prefer companies with a proven stability. Most analysts consider businesses within 2 to 5 years of operations to be more trustworthy. Significantly, or reducing revenues significantly or having much significant revenue fluctuations may make it difficult to predict future results and assess stability. For instance, in our case, this is the issue also with other creditors other than the employees themselves. They will also look at the same situation. But what we've picked up is that some of the creditors or suppliers, they want to deal with small businesses that are more than 5 years old. This also shook the employee line item as well, not only the sales, but if you look on the differences between the employee related expenses, there are huge jumps between the previous year and the current year. Also, having only one director like Mr. Ndubin in our example may threaten the going concern since there is no clear succession plan. This creates risk for employees who may lose their job if anything happens to Mr. Ndubin. The fact that Ndulin Pty Ltd is a juristic person and exists in perpetuity has its own practical problems, especially when this is not adequately addressed or paid attention to on time. Though these are the issues that employees might worry about. So when we look on the warning signs, we can see that the company is less than 2 years old. There are fluctuations in revenue. There's one person in the leadership. There's no succession plan. There's no website dealing with giving more information about the business. There's no organogram. The financial statements are not published. The shares cannot be bought from Mr. Ndulin on time. As it is, there's only one member we got no details whether he has previous partnerships or not, or he was trying to get other partners into business. But what is consoling is that the entity itself is the member of SPPSA. The entity itself is a member of SPPSA, so the continuity is granted in the sense that if anything happens to Mr. Ndulin, SPPSA may find ways for that entity to continue by working through with the office of the master. And of course the family, if the family is still there and is interested in the company going forward, because there might be internal barriers that may stop the company from continuing. But the fact that SPSA is there and is willing to work with the family and the master to make sure that the company is going forward, at least on that particular one, it's not something bad. Silent signals of going concern. You can see that on the employees side, employees are more worried about the going concern, because if you look at it strictly, we've been talking about going concern when we're talking about employees for quite some time now. Let us look on the behavior. Now, when the owner starts working late or leaving early, the employees will think that she's losing interest or has got plan B. Sudden budget cuts or expense freezes, the employees will think that the business is running out of money. Client meetings are rare. Sometimes something is going wrong with the sales. That's what the employees will think. Increased secrecy from leadership. The employees will think that the leadership is hiding something the business can close at any time. That's what the employees would think. It looks like these employees don't have much to do, and I'm not sure whether the authors thought that the business owner should tell the employees his or every step of the way. I'm not sure how these characteristics must be managed. I don't envisage a situation where you talk everything all the time to employees, but I think what is important here, you can just create a culture of monthly meetings where you guys are getting feedback one another from one another. What are the things that must be corrected going forward? And all those things. How should we do things? What should be changed? Who must do what? And so forth. We have seen this in most retail outlets and clothing shops. In the morning, there's a meeting to say one is akapagamisi, is not pulling up. That person must be changed from where he's working to another. The strong points of that person are sitting there instead of that. Yeah, but I think that does not give away your strategies. I mean, you've got no responsibility to say all of these things to employees. Remember, you are not an employee; they are the employees. Okay, so here are the industry company classifications. So if your company has got 1 to 10 employees and has got less than 5 million turnover, it is a micro enterprise. Your entity becomes a small enterprise when it employs between 11 to 50 employees and the revenue is between 5 million and 20 million. It becomes a medium-sized employees when it employs 51 employees to 250 employees and the revenue is between 20 million and 80 million. It becomes a big entity when it has got more than 250 employees and the revenue is more than 500 million. Size classification isn't just a statistics, it determines grants, tax breaks, investor fit, tender eligibility, and compliance requirements. So you must monitor your revenue because it is revenue that locates you to a correct bracket and responsibility. Why size classification matter to employees? It talks about tax benefits, tenders, compliance, and funding. Perhaps some of the employees might not be interested on this, but they might be affected by how the entity deal with these. BE classification, your BE classification isn't just a compliance paperwork, it's a competitive edge and a legal passport to millions in state and corporate spending. So it's important that you get your BE certificate and BE compliance intact because those are the things that can help you going forward. Now, if we look on the income statement, the uh, if we can just summarize here, we can say that we should remember that income is in the income statement has got a traditional formula that says income less expenses is equal to profit, or income less expenses is equal to loss. And here in this slide, we're focusing mainly on revenue and expenses. Um, the second setting of cost of sales it's when the business is selling inventory. All right. We should remember that where the entity is in the services industry, in other words, they are selling services, their income statement must start with service rendered. Okay. Where the business is selling goods, their income statement must start with sales. There are instances where the entity renders services and make sales as well. So what is important there, we must understand which one is bigger than the other. The bigger one will start the income statement. If we look here on the operating expenses, we're talking about salaries, rent, marketing, fuel, data, etc. All the expenses that we talked about when we started. And this is where our situation is. Okay. Our entity, we've realized that it's truly labor intensive. because but we could not pick up any information about bonuses. We don't know how the employees may feel about the fact that there are no bonuses, or the employees do not know whether the bonuses are not disclosed in the financial statements because in any way they don't have access to the financial statements, or it doesn't really matter to them because reporting is not their business. What is important to them is that they got their business, their bonuses when they were due. In the event there were bonuses, we must calculate taxes there. If we look on this bracket that says what is left before tax, we must make sure that pay as you earn and UIF has been taken into account in EMP 201. An income statement tells the truth when your ego won't. You can talk big, but if your income statement says you are drowning, then you are drowning. But we want to make sure that you understand the role of non-cash items in the income statement, because the income statement can say that you are drowning, and when you loosen out your non-cash items, a true cash position can be revealed. Take for instance our case here, where we made revenues of 11 million and the profit of 360,000 rand, but the cash flow shows a profit of 779,000. So it means the difference between 779 and 360 were non-cash flows. So it's possible to have a loss on profit but a positive bank balance. But it can do this only if the information is accurately accounted for and all items are complete in the financial statements. The process of making financial statements complete is a very difficult process, and it requires a cooperation between the users of financial statements and between the preparers of financial statements. The balance sheet, your financial x-ray. Here we're looking at three quadrants. Perhaps let us start about the traditional formula for the balance sheet. Start with the assets. In the assets, we'll see both non-current assets and current assets. We're going to see equity. In equity, we're going to see almost four things. That is the share capital. We're going to see the retained earnings. We're going to see the current financial year's profit. Then we're going to go to the liabilities. Liabilities, they are same as assets, same in the sense that they disclose non-current liabilities and current liabilities. So on the assets, we get to know about what the business owns, and the key question is, are these assets working for the business or are just a dead weight? That's what the employee is asking. Employees are only concerned with assets that are consistently working for them to get their salaries. They don't really bother much about assets that have no value to them. On the liabilities, what the business owes, the question is, can I pay these off soon or will they shock me slowly? Now, that is the owner of the business who's asking that question, because the more the liabilities are and the quality of the liabilities, the more the employees are worried that one day their salaries may not be paid because of the level of the liabilities. Expenses, cash flow, and payment priority assessment is very important here. So, but we must remember that the financial statements are not available on a month-to-month basis. These are the considerations that are normally done when the financial statements have been published or during the job searching when the person is searching for an appropriate job opportunity. Equity, what is left after all the debt? Key question my stake is my stake growing or being eroded by poor decisions? Okay, so it's talking about expense management. Remember that we saw a situation where a business managed to grow its revenue to 11 million, but could not manage its expenses and resulted in a lower profit compared to a year where there were lower revenues. So business growth and bonuses are reflected in the equity form. So this part of equity is important for most business stakeholders as well. So if we're looking on the current liabilities here, because we're also dealing with the employees, we can say that in the previous chapter we talked about the working capital, and we have considered the employees as suppliers to some extent. Could this mean that in the working capital the employees will be worried, or will they matter? Will the working capital matter to the employees at all? What about the fact that the employees do not invoice the company? Could this preclude them from worrying about the working capital? Maybe the employees can worry about the working capital to the extent that who is sitting in the working capital, how much of employee related items are in the working capital, and what is making the employee related items in the working capital. For instance, are there any salary uh, um, credit, trade creditors there? What about UIF? What about pension fund? What about medical expenses? Will the employees worry about now about the working capital? Yes, because it means most of their benefits are not paid. The balance sheet does not lie. It tells you what your business owes, what it owes, what your business owns, what it owes, and what truly yours. It's not just a form, it's an x-ray of your business health. Indeed, it's an x-ray, a balance sheet. The cash flow statement of the business will show those four items there. It will show the operating activities, the monies that you get from the ordinary activities of the business. We say that is the heart of the business. The investing the investing activities, the money is used to buy or selling assets. Those can build or drain the liquidity of the business. Then you've got financing activities, loans received, repaid, equity injections. It shows exactly the funding dependence there. If profit is food, cash is oxygen. You can live without food for a while, but without oxygen, you are done in a minute. Most businesses collapse not because they were not profitable, but because they ran out of cash. They moved at the wrong moment. Rent was due, salaries hit. A supplier wanted immediate payment, and the customer invoice was still being processed. It's bad, yeah. But these are true realities of of what is happening in the small business environment, and these are the issues that you really have to come in informed about, and these are the issues that really can make you decide if you want to come in here or not. Okay, so we've got three quadrants at the end. We've got a quadrant that says employees are watching, trade unions are not the enemy, they are mirror showing what staff feels but cannot say loud. When managed well, they become your best human feedback. But the issue is that at a small business environment, there are no unions. In quadrant number two, size sharpens power, shapes power. Your business classification determines legal obligations, tax break, BE potential, and access to growth incentives. If we master this position to unlock it, mastering this position will unlock funding and procurement opportunities. There are a lot of procurement opportunities within the small business, but the only sad part is that Things are given to one people all over again. So there is no growth strategy there. People drive profitability. Staff cost isn't just expenses, they are investment. A demotivated team costs more than a salary increase. Employees know when your business is struggling before your accountant does. That is what we get from the third quadrant. On the fourth quadrant, financial tells human story. Your statement your statements reveal how hard people have been working, whether the business model rewards them or not, and there is trust between you and if there is trust between you and your staff members, they are not just reports, they are survival maps. You can now sum up and understand the reporting of financial statements. I feel like this volume is wonderful. This volume was written with passion, I mean, my wife and I have written a lot of these volumes, but this one, I feel like, you know, I don't. Maybe we were in the cloud or wherever, so we've done our best here, even if we say so ourselves. Ladies and gentlemen, that's the end of chapter 4 of this series. We're now gonna go to the next session, that is cycle 2.4. In cycle 2.4, we will be dealing with government regulation and customer. Then cycle 2.5, we're gonna only deal with one chapter, that is competitors, but it's a big chapter. Then we're gonna combine cycle 2.6, that is gonna be members of the community and the directors. Ladies and gentlemen, my name is Kholehlatla Fuzane. Thank you so much for this wonderful section.